Do you think the Mueller conclusion will have any impact on any economic policy from the Trump administration for the rest of his term?
No, I don't think so. I mean, Washington was dysfunctional before the Mueller report. It's going to be dysfunctional after the Mueller report. I don't see any substantive economic policy getting done between now and the end of President Trump's term. So I think investors know that, and that's why they're not reacting to the news today. So I don't think anything has substantively changed here.
Samir, what about those expectations of a trade deal? Where do they stand right now?
I mean, I think the baseline for markets has been for a little while that there will be something more than just extended trade, and at least some sort of an appreciable rollback of tariffs, and which is, I guess, where the risk also comes from, because so much noise around how we are getting to that point that if indeed we don't see some of that rollback, it could be sort of a lot more damaging for market sentiment.
What is your view of the state of the Chinese economy right now? I mean, when we say it is weakening, how weak is it?
I mean, look, I think a large part of the downside is obviously coming from exports, and we know that we are facing a bit of a cliff here. Part of what has happened to exports so far has been about front-loading a lot of the orders because we knew these tariffs were coming. Now there is the whole expectation that maybe at least they'll go into suspension and hopefully some sort of a reversal. If that doesn't happen, I think we could see substantially more. I would also argue that a lot of this is about policy. I guess expectation is that policy will arrest that downside. If that was to come untrue and a policy is not able to or willing to actually go in with as much stimulus as people expect, then that's, I think, where the real shock to the downside comes from.
I mean, broader than China, Mark, is the global slowdown getting worse or getting better? We all thought it was stabilizing and then got that 44 on German PMI, and there was another freak out about global growth, and you certainly saw that in the bond market. So which way is it going?
You know, Sarah, it feels a lot softer than I had expected or thought. I mean, the slowdown has been more pronounced than I would have thought just a few months ago. Now, I expected some slowing because, you know, the U.S. had all this fiscal stimulus, deficit finance, tax cuts that juiced things up last year, and that went away. So we'd see some slowing no matter what. But this is much more pronounced, and it's not bouncing back. We run a survey, a sentiment survey, business sentiment survey, global survey, off of one of our websites, and that fell sharply beginning last fall into this year. And then I thought, well, you know, the stock market has improved, the government shutdown is over, China is implementing fiscal policies to re-stimulate their economy, and we'd see the sentiment index bounce back. It has not, and it's very consistent with a global economy that is very close to stalling out. So at least through the end of March, I don't see a sign yet that the global economy is bottomed out. It's making me more nervous. Now, I fully anticipate the global economy coming back to life here. I think the Chinese are now fully engaged and want to get their economy going again. And, I do think we're seeing, the Fed pivot and all those kinds of things. But I'm growing more nervous here about what's going on.
The movement of the currencies is also very important here.
Absolutely.
What is your sense in terms of the dollar and the RMB?
Yeah, I guess, look, I mean, in the near term, it's obviously very dependent upon what is the shape and form of the deal we get. But there is clearly more narrative to understand that any sort of an arrangement will include the currency, and especially the dollar RMB pair, being kept into a bit of a range. And if that happens, I think the more critical part is that would mean the currency can no longer be used as a policy stimulus tool, which means you've got to do a lot more on other sides, which is either via interest rates or via much more active fiscal policy.
Finally, Mark, the great yield curve debate going on right now. So it's a pretty reliable recession indicator, but that could be, in 18 months, it could be in less than that, it could be in 5 years. I mean, how do we actually interpret the signals from the bond market?
Whether it's signaling recession or not, I mean, that is a matter of debate. But what the yield curve is strongly signaling, and I don't think there's any debate, is that the economy's growth rate is going to be much, much slower over the next year or two than clearly it has been over the past year or two. So whether we get a recession or not, I'm not sure. I mean, there's a lot of things that are affecting the yield curve that haven't been here historically, like global quantitative easing. But I think the message in the yield curve is the next couple of years are going to be a bit of a slog.